Tokyo on a couple things. We were able to come through the debt and buy about 50% of 07 value. So that probably was interesting. One of the themes that I think is important at Westbrook, where we're focused right now, is on making sure we stay true to our strategy. So we focus on these gateway cities, smaller assets. A lot of times need operational turnaround. We have not been buying those with leverage. We've been buying them unlevered. And then after we renovate and reposition them and get them levered up, get cash flow, then we'll put some leverage on it. And I think that's generally been something we've been even more focused on as prices have risen in a lot of the gateway markets. Just in case there is a correction, we think we have a good basis. We don't have a capital structure that will cause issues, and we can ride through the cycle. And in these gateway cities, we think we'll come out on the other end. So that's not one example, but I definitely think it's an important theme that we're pretty focused on.
Sure. So we've been spending quite a bit of time thinking and researching the senior housing space for about 2 years now. It's an interesting market underpinned by very strong demand fundamentals as the senior population in the United States ages and relatively limited new supply. But it's difficult to find deals because the REITs, both public and private, are voracious acquirers of assets, and most of the assets are fairly stabilized, and we just can't compete. And then in the summer of 2012, we spent some time looking at a company called Assisted Living Concepts, ALC. It was a public company, highly distressed. Its stock price had fallen by about 60%. It terminated its CEO for cause after a series of negative events. And we started a proprietary dialogue with the controlling shareholder of that company, which is a high net worth family up in Canada, which ultimately led us to acquire ALC in a public to private. It owns 212 senior living, assisted living facilities throughout the country. We bought it for about $65,000 per owned unit. Replacement cost about $130,000 per owned unit. If you look at the average trade for assisted living throughout the country, it's $150,000 per owned unit. But the problem here at ALC was that their facilities were 60% occupied, while the national average was 90%. So an intense operational turnaround with potentially lots of upside if we get 60% closer to the national average, and we can sell assets for closer to the national average sale price. So that's a deal we did. We just closed earlier this year. We financed it with about 40% debt. Only about half of our assets are actually financed. So we have a big pool of unencumbered assets, and we financed it through CMBS financing for JP Morgan.
So we've done a lot on the distressed residential and small balance loan side, but something that's a little bit more different that we did was when we identified the management team, the sale-leaseback business a couple of years ago, that there weren't a lot of people, lenders specifically, out financing non-credit tenant, called franchisees, fast food restaurants, grocery stores, movie theaters, things like that. So this management team had just come off of its non-compete on one of its businesses that it had sold, and was looking to get back into business. And they came to us and we started talking about it. The business is pretty simple. We're out buying 15 to 25 year assets net lease to the operator. They're small assets. We're buying at about a 9% cap rate, and the financing costs, it's really a spread lending business. The financing costs that we're able to go to Wall Street with and finance, it's costing us anywhere between 4.5% and 5.5%. So it was really just a unique sort of rifle shot opportunity to step into a market and fill a gap on really the lending side, where we now have about $1.25 billion of assets in that company, and we'll continue to build out that platform. And then at some point in the next 12 to 24 months, probably look for a partial exit or a full exit.
All right. I think other opportunities that we've looked at this year, this is not in Oahu, but we did find a distressed opportunity in Hawaii, where we acquired the debt of a development called Capital Bay. It would have been made into Ritz-Carlton residences. The Lehman estate owned a significant portion of the debt. We bought out all the other lenders, and then in partnership with them, basically took over the asset around a $100 million basis, around $300+ million construction cost for the asset units that had not been sold. We subsequently terminated Ritz-Carlton, established an agreement with Montage to come in, invest capital, put a very small hotel in, and otherwise help us in the sell out of the residential units. And I think we see some of the same macro trends that obviously are hitting Oahu directly of Asian investors and frankly people wanting to come and own homes in Hawaii, and that's something that has continued to persist this year, and we think will pick up steam. And it's a very supply-constrained market as one would imagine, and so we really like our basis in that and think there's a great opportunity.
This